Newsflash, you do not need to trade your retirement account based on what's happening in the headlines today. I'm Kate. I have helped countless people retire and stay retired, and I'm actually about to join a new investment advisory firm in the next few weeks. I'm really excited about that, doing some more financial planning. So I will keep you in the loop as that happens. And as that happens, I will probably be in a position to help some of the YouTube audience as well. So I've got my other monitor here, and I want to start out. We are looking at the S&P 500. Great place to start. And there's been a lot of news lately about bombings in Iran. And remember, whenever you're watching this, it's okay because the lesson is going to apply here. What happened today is over the weekend, after this news broke, a lot of people thought, oh my gosh, the markets are just going to tank. We are just going to be in a tremendous amount of trouble financially. There go my retirement funds. Now, you can take a look here at what happened with the S&P 500. It actually ended up higher today. And I can pop over here to a 5-minute chart. You can see a little bit what happened. Markets kind of realized early on that the news was not going to be as devastating as they thought. You did see a sell-off midday, and then once again in the afternoon, when they realized that Iran's retaliation was mostly symbolic, then what they did was they retaliated against a base in Qatar. I think I'm saying that right. I've heard a lot of ways to pronounce that. But basically, the markets realized, hey, this isn't as bad as we initially thought. Now, what happens is a lot of individual investors do tend to panic. I have seen this over and over again, and that's why I'm showing you this today. A lot of people tend to believe that bad news means a market crash is coming, but be careful about making these assumptions. Let me go back on my S&P 500 chart right here, and I'm going to go to a monthly chart, and let's go back to 2013, okay? So, right back here, all of you remember 2009. I mean, if you are old enough to be thinking about retirement soon, you remember 2009. I do too. We were all inundated with all the bad news constantly. It wasn't just the markets. It was the housing market in addition to the stock market. So really, there was kind of nowhere to hide, okay? And people were exhausted about all the bad news coming out, and they didn't realize what was happening right in here after March 2009, how the market started moving higher. And what happened was people sat in cash for far too long. I remember hearing many conversations back in the 2010, 2011 timeframe when the market had already been rallying, and people saying, oh, I'm still in cash. Well, that wasn't as smart a move as they probably thought it was, okay? Because what does that do? You lock in your losses down here somewhere, okay? And, whenever you sold, maybe you sold in here, maybe you sold down there, kind of where you capitulated, just couldn't take it anymore. Maybe you even sold in here because you didn't trust the rally. And that's actually been a theme in the past 25 years, I think, is that people do not trust market rallies. Now, what happens, though, is if you sell down here, what does that do? It makes it harder for you to get back to even, or even make money. And if you had just stuck with your plan, let's just reset this back to today. I mean, people who did not panic and run into cash back then were pretty happy about the gains they made in the market ever since then. But it's always difficult, right? It is never easy. Look how many times there have been. You had this flat area down here, real choppy back in here. Of course, that was 2020. We remember that. You had some problems back here in 2022. And every time this happens, right, people want to give up and sell out. Now, the other thing that happens is people want to know why. And I get it. That's sort of human nature, is to want to understand what's going on. And frankly, it really doesn't matter why the market is doing what it's doing. I will say more about that in a minute. But let me just, I will, just for fun, let's go over what we are looking at here. we have some news here about a Fed governor saying that there could be a rate cut in July, and markets do tend to like that. Federal Reserve Vice Chair Michelle Bowman said she would support cutting interest rates as soon as July if inflation pressures continue to ease or if signs of labor market weakness intensify. So that's something contributing here. And then, of course, you did have the news about that the retaliation against the base in Qatar was not as bad as people had feared. And that's all right here, why it led to oil prices to fall and the S&P to jump 1%, because there is not looking like there's going to be a closure of the Strait of Hormuz. So the concerns about oil prices didn't happen. So there's always a why to what's going on. Okay? Just want to point that out. But do you remember, I know you won't, think back a year ago, 3 years ago, 5 years ago. What was moving the market? Do you remember? I'm sure in some of those years there was something in there that caused the market to decline or to skyrocket. I don't know. I don't remember. I didn't go back and check on what happened on this day a year ago, 3 years ago, 5 years ago, 10 years ago. There's always something. And this is kind of back what I was showing you in the S&P 500. Let's look at a daily chart of the S&P 500. My gosh, that is scary, right? All this day-to-day noise. If you focused on that, you would be tempted to sell each and every day just to get out of there to alleviate the panic. But then you go back to a weekly chart. Well, that's a little bit smoother, isn't it? And then this is what I showed you before. The monthly chart just shows you over time how markets go up. So the news of the day doesn't have that long-term effect to your retirement account that you might think it does, even though you're scared at the moment. Now, this doesn't mean you shouldn't have some short-term funds set aside in some low-risk instruments to pay your bills in the near future. I'll talk about that. I actually just wrote an article about that. That's just smart retirement planning and management of your accounts. That's different than reacting to the news because you think you should be trading. So that is one thing I wanted to show you. I also wanted to show you this. It's a chart from a company I really like a lot. It's called Dimensional Fund Advisors. I've worked with them in the past, hope to work with them again after I joined this new financial planning firm that I'm looking at. Now, say you invested $1,000 in the Russell 3000 very broad index in 1998, and you had kept it in there until 2022, okay? So here's the growth of that $1,000 during that time frame if you had just left it in there. So that would have grown to $6,356. But if you had missed the best week in the market during that time, that would have declined to $5,304. Here's what would have happened in the best month had you missed that. The best 3 months would have been $4,480. And if you had just been so scared during that time, and there was plenty to be scared about during that time, right? I mean, you had 9/11, you had that recession that happened around 2002, you had 2008, 2009, right? The great financial crisis. So if you had set your money aside and parked it in cash for 6 months, you would have only had $4,125. That would have been the growth, okay? And that just shows you how missing only a few days can really severely harm your return. So what that means, focus on a consistent, diversified strategy and ignore the short-term noise. And here's why, kind of what I was talking about a minute ago. I'm circling back to why the why doesn't matter, why the headlines do not matter. Markets are efficient. All the known information is priced into stocks. And no, there's not some mysterious dark pool out there that has all this knowledge that's going to manipulate markets better than the broad consensus knows. There's no wide-scale insider trading that is going to affect the broad market. Publicly available information is priced in there. You know, all these research firms, they have analysts, the big brokerages, mutual fund companies, they study what's going on. They know what information is available there. So that's what prices do reflect. Hey, if you want more ETF tips for your retirement portfolio, here's my free guide to ETF income generation. Now, the idea here is to build a strong, diversified retirement portfolio with the right inputs, okay? And that's why I've put together this ETF guide to help you grow and protect your money. From dividend growth and low volatility ETFs to international exposure and inflation hedges, this guide covers it all for you. So whether you're looking for steady income or long-term growth, these ETFs can support your retirement goals. So if you're ready to level up your portfolio, check out the full guide. Link is in the description. And it's really behavior that hurts your performance more than anything else. I mean, it's this. We're back to this, right? If you panic, get out of the market. That's what hurts performance, rather than if you had just hung in there with your balanced portfolio, adjusted for your plan. You do have a plan, right? You're not just guessing at this. I hope not. That is how you make the returns that you need to support your lifestyle in retirement. It's not by trading like a crazy person and trying to time the market. So I want to look over at a few other charts here in the interest of discussing balanced diversification. I'm going to go back over here, and I'm going to put in this ticker is EFA. And what this is, let me go back to a weekly chart. This is an ETF that tracks international, developed market international stocks outside the U.S. Now, I'll go over here. Here is the return of this EFA ETF so far in 2025. 16%. It's up more than 16%. Well, let's compare that to the S&P, the one that everybody knows about, right? That's only up 2%. Now, in the past several years, I mean, let's look over at the past 15-year basis. You've got the S&P 500 was up 13.84%, and on a 15-year basis, you've got this EFA ETF up 6.87%. So the point I'm making here is that, yeah, U.S. stocks, I mean, just the growth of all these big U.S. techs, they have been dominant over the past 15 years. And a lot of people have wondered, why do I even need these international stocks? They're just a drag on my performance here. But as 2025 has shown, you don't know when any specific asset class is going to outperform another. And I think this took a lot of people by surprise. So anyway, just to emphasize, short-term volatility is very, very normal. Go back over here to, I mean, look, if we look at the chart of the EFA, the same thing. If we look at a chart of the S&P 500, and I think this is a better one just to show because more people are familiar with this. The short-term daily action can be very frightening, but your plan is built for the long haul, and this means don't make a bunch of trades in response to the headlines because, as it turns out, the market action may not go the way you think. Markets move every day. Your retirement strategy is about the years, the decades, not what happened in the market at 1:30 p.m. today. All right, please hit subscribe. I will be doing more of these retirement-themed investing and planning videos. I also will be doing more lives. Click the link for the ETF report, and you can get the retirement email. All right, I'll also be starting a dividend newsletter soon, so would like to share that with you. Thank you so much for watching today. I appreciate you, and don't forget to hit like and subscribe. All right, bye.